This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Then there were three. Anthem's purchase of rival health insurer Cigna raises new questions about competition, costs, choice, and what may change when you go see your doctor.
Steer clear: how Fiat Chrysler plans to fix its vehicles that are susceptible to being hacked.
And money and politics: what presidential candidate Hillary Clinton has planned for your investment returns. All that and more tonight on Nightly Business Report for Friday, July 24th.
Good evening, everyone. I'm Sharon Epperson, in tonight for Sue Herrera.
And I'm Tyler Matheson. Welcome. You know, it was a very rough end to the week on Wall Street, but we begin tonight with a deal that could change further an industry that touches the lives of every single American: healthcare. Anthem said it is buying rival Cigna for $54 billion in a tie-up that would create the largest health insurer in the country by membership. The deal comes just weeks after Aetna said it wants to buy Humana, quickly altering the landscape from 5 major insurance players to just 3, assuming the announced deals get regulatory approval. Both Anthem and Cigna saw their shares fall in trading today, and not just by a little. And as Bertha Coombs explains, the wave of consolidation is raising a number of questions about the power of these companies, competition, and costs for patients.
Anthem and Cigna say together they'll be able to cut out more than $2 billion in overhead costs, and ultimately that'll be good for consumers.
It will improve our ability to serve customers across commercial, Medicaid, Medicare, and international markets, and create greater efficiencies and affordability for our customers.
The sheer scale of the $54 billion merger will attract regulatory scrutiny. The combined company will have more than 50 million members, covering nearly 1 in 5 Americans. But regulators will likely look at the Anthem-Cigna deal alongside Aetna's proposed $34 billion acquisition of Humana, which would reduce the top 5 insurers to just 3 big players, including United Health.
It's almost like we're going to have a Ford, Chrysler, GM situation in the healthcare market.
In one of the nation's top markets, California, where Anthem's already a leader, its market share would increase by 19%. Insurers argue getting bigger helps them get better prices from large hospital operators. Analysts say that could help the overall market.
Based on research that we've done, they don't substantially reduce the competitive dynamic in markets. And so what is happening is that you're creating more capable companies, but you are not necessarily reducing the competitive situation in a market.
Consumer groups worry fewer choices will just mean higher prices for individuals, employers, and in Medicare Advantage. Antitrust experts say the companies have to make a strong case to regulators that it won't.
They can, in fact, become more efficient, and they should be able to lower the rate of increase of their prices. But as you know, in the hospital sector to some degree and in other mergers, we frequently see price increases.
While Anthem and Cigna express confidence their deal will be approved, it could take well over a year, and they have included a breakup fee in their agreement. Bertha Coombs, Nightly Business Report, New York.
Let's turn now to Zach Cooper to talk more about what the consolidation in the healthcare industry will mean for you. He's a health economist at Yale University. Thanks for joining us. So another big merger here in the insurance space, and we're looking at what it will all mean for the consumer. What will it mean?
Yeah, so I think if history is any guide, it's unlikely that this merger is going to lower prices. I think if anything, it's going to raise them. You know, we can look at history. So there was a merger in 1999 between Aetna and Prudential that raised premiums for consumers by about 7%. If we look at the exchanges on the Affordable Care Act, the areas that are more competitive have lower prices for consumers. So I just don't think that this is going to be something that's particularly good for our consumers.
So you heard all those executives: better efficiency, more affordability, serve customers better, lower rates of increase. You're not buying any of it.
Well, Tyler, I think it's pretty clear why they want to merge. I mean, these private insurers are playing a much, much larger role in healthcare in the U.S., in Medicare and Medicaid, in the federal programs. And the reason they really want to push for these mergers is that provider markets are becoming much, much more competitive. And it's just not clear that as these insurance companies get bigger, that they'll pass on any savings they make onto consumers.
What about the Department of Justice? Will they really agree to this merger, another one in this space? We're going to only have 3 major insurers out there. Is that enough competition? What do you think DOJ will say?
So I think pretty clearly DOJ is going to have a very, very hard look. And what they're going to be looking at is to the extent that these different companies have overlapping markets in particular areas. And I think in certain instances they do. I mean, you can look at the national market, for example, or you can look at New Hampshire, where in the small and large group market, Anthem and Cigna do have a significant amount of overlap. We can also look at some recent precedent from the Comcast-Time Warner deal that fell apart, where they said, look, big purchasers, monopsonists, that's not an argument for these types of mergers. So I think my instinct is that these will go through, but I think what we're going to see is probably some divestment and a very, very hard look from the DOJ.
My sense is that the real driver here is to enable the insurers to have the bulk to deal with the big healthcare institutions, the hospitals, the medical practices, so that they, in the same sense, and I don't mean to overstate the analogy, like Walmart, can effectively dictate the price to the vendor. Have I got that right?
You've got that totally right, and that's actually where the complexity really comes in. So these insurers, they want to be bigger players at the negotiating table. But at some level, the argument that they're going to make to the DOJ is, look, we're not getting bigger in the same markets. So if their argument is this gives us more power, this allows us to negotiate, at the same time they can't argue that they don't have overlapping markets.
The government will certainly have a lot to look into. Certainly a lot of complexity and a lot for the government to look into. Zach Cooper with Yale University, thanks for joining us.
The Food and Drug Administration has approved the first of a new generation of cholesterol drugs. The FDA did, however, limit the drug's use to patients whose cholesterol problems stem from hereditary issues. The drug, made by Regeneron, will be expensive, about $14,000 a year. That's a lot more than I pay for mine. Those limits on the drug pressured shares, which closed down 2.5%.
Tyler, on Wall Street, the blue chip Dow index finished the week with a triple-digit decline on concerns about slowing global growth after both China and the Eurozone issued disappointing manufacturing data. By the close, the Dow Jones Industrial Average fell 163 points to 17,568. The Nasdaq dropped 57 points, weighed down by shares of Biogen, which saw a double-digit decline. We'll have more on that later in the program. And the S&P 500 sank 22 points. For the week, all of the major averages fell more than 2%. It was the largest weekly drop for the S&P 500 and the Nasdaq since March.
Amazon, Sharon, was easily the top-performing stock today in the S&P 500. This after it reported an unexpected profit and a blowout quarter, which we told you about right here last night. The stock jumped nearly 10% today, as you see there, and that brings its total gain for the year to about 70%. John Fort tells us what's driving Amazon's business and whether it can continue to stay in the black.
Amazon's known for delivering all kinds of items, but investors got a surprise package this week: profits. And that raises the question, after 2 decades watching Amazon invest nearly every dollar it makes to fuel growth, are we seeing the beginning of a new, consistently profitable era? Don't count on it. Amazon founder and CEO Jeff Bezos has been known to show earnings now and then, perhaps just to remind investors he can. But meanwhile, Bezos has already set his sights on some expensive new frontiers: international e-commerce growth in countries like Spain, Italy, and India, and continued dominance of the cloud, which sees Amazon's Web Services Unit, or AWS, buying and managing computing resources, then renting them out to customers.
They're definitely investing in future growth areas, but we like the fact that they're investing around their core retail business, AWS, and the marketplace opportunity. You know, they're not investing in driverless cars and rocket ships. So, you know, they're investing in the prime business.
Okay, back. Amazon's also spending big money making original movies and TV shows like Golden Globe winner Transparent. The bulk of those production costs, a 9-figure expense, will appear this quarter. So don't expect Bezos, who managed to grow sales 20% last quarter thanks to his big spending ways, to schedule a profit delivery every quarter. For Nightly Business Report, I'm John Fort.
American Airlines says it had its most profitable quarter ever. The world's biggest airline saw its earnings nearly double as cheaper fuel helped lower costs and offset a decline in revenue. But the company said that passengers paid less per mile in the second quarter than they did last summer, and they expect that trend to continue. That outlook pressured shares, which fell 7%.
American is one of 5 U.S. airlines under investigation now for possible price gouging. The Transportation Department is looking into whether American, Delta, Southwest, JetBlue, and United raised fares while train service between New York and Washington was disabled following that deadly Amtrak crash outside Philadelphia in May. The Northeast Corridor is one of the most heavily traveled areas by plane or train. There is a second investigation into the airlines, one by the Justice Department, examining whether the airlines work together to illegally keep fares high. And Fiat Chrysler issues a major safety recall to block its vehicles from hackers. The recall covers about 1.5 million automobiles and follows the recent revelation that moving Jeep vehicles can be controlled remotely. Phil LeBeau has more on what may be the first of its kind recall for the industry.
The video is startling. A driver losing control of his 2014 Jeep Cherokee while a hacker uses his computer to tell the vehicle what to do. It was a planned hacking, exposing a flaw in the software of Jeep infotainment systems. Now Fiat Chrysler is recalling 1.4 million models built between 2013 and 2015. The owners will receive a USB device and can update their vehicle's software without visiting a dealership. Fiat Chrysler says that aside from the planned hacking, there have been no cases of models being hacked remotely. And one of the people who exposed the Jeep software flaw says the odds of cars being hacked is still incredibly low.
Charlie and I have spent the last 3 years of our life doing this research and a year on the Jeep alone, so it's not easy to do. I'm more afraid of someone texting and driving and running into me than I am someone hacking my car, if that'll tell you anything.
With self-driving cars quickly becoming a reality, concerns are growing automakers have not done enough to make sure strangers cannot gain remote control of those cars. That's why cybersecurity is rapidly becoming a primary focus for automakers and regulators who want to make sure hackers cannot get control of millions of vehicles out on the road. Phil LeBeau, Nightly Business Report, Chicago.
The National Highway Traffic Safety Administration says it encouraged Fiat Chrysler to recall those vehicles, and it will examine the effectiveness of the automaker's proposed anti-hacking fix.
It was a very busy week for earnings, and we're not done yet. Next week promises to be an interesting one as well, and as Bob Pisani tells us what to watch, we'll hear from him from the New York Stock Exchange.
The focus will again be on earnings next week, but as always, a small number of companies will be in focus. There's a lot riding on Facebook, which reports Wednesday, because the stock's up 20% in the last month on expectations of a strong report. Investors have piled a lot of money into a small group of big cap tech names. Good news dramatically boosted Amazon and Google, but even the smallest disappointment hurt Apple. Traders will also be scrutinizing big international companies for the impact of the strong dollar. So Procter & Gamble, for example, gets 65% of its business outside the U.S. They're going to be reporting Thursday. Other multinationals that have already reported have noted a significant impact from the strong dollar. The two biggest energy companies, Dow Components, ExxonMobil, and Chevron, will report at the end of next week. We all know it's going to be awful. Chevron's earnings will probably be down 55%, but estimates have been coming up a bit for them, and they'll be scrutinized for any indication of when the oil slide may stop. It's not so much the earnings, it's the guidance for the third quarter that really matter. Earnings growth was expected to be positive in the second half of the year, but the expectations for the third quarter are now also expected to be down. That's a problem. That's one reason the markets have had so much trouble this week. What's the problem? You've heard about it. Slow growth in China, slow growth in Latin America, but also the dollar strength and weak oil has continued into the third quarter. The Fed told us that a strong dollar and weak oil might be transitory. That hasn't been the case. The bottom line, growth is proving to be very elusive this year. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Still ahead, what presidential candidate Hillary Clinton has planned for your money and your taxes.
The Federal Communications Commission has cleared the way for AT&T's $49 billion acquisition of DirecTV. The deal will create one of the largest pay TV providers in the country and removes one of the biggest hurdles that had been standing in the way of the merger. Earlier this week, we reported that the approval was near. Shares of both AT&T and DirecTV finished the day with gains.
Sales of newly built single-family homes fell last month. The Commerce Department reported a decline of 6.8% in sales to their taking sales to their lowest level in 7 months. Home builders, however, came under pressure, falling in today's session, as you see there.
Presidential candidate Hillary Clinton has a plan for the economy. She's asking businesses to focus on long-term investments rather than short-term profits. In a speech today in New York, she outlined a series of policy proposals that could impact your investment returns. John Harwood was there.
Last week, Hillary Clinton laid out her plan for more profit sharing to benefit average workers. Today, she came to the NYU School of Business to push back against what she called quarterly capitalism and encourage longer-term investment. Her centerpiece proposal, a shift in capital gains taxation to have higher rates for investments held for a shorter period of time.
So as president, I would move to a 6-year sliding scale that provides real incentives for long-term investments. For taxpayers in the top bracket, families earning more than $465,000 a year, any gains from selling stock in the first 2 years would be taxed just like ordinary income. Then the rate would decrease each year until it returns to the current rate. This means that from the moment investors buy into a company, they'll be more focused on its future growth strategy than its immediate profits.
The capital gains proposal was just one of the ideas Hillary Clinton offered to encourage long-term investment. She also said she wants to discourage some activist investors from pushing for short-term profits through means such as stock buybacks. She also wants to make sure that incentives for executive compensation are not tilted towards short-term stock options.
Now, I am all for rewarding CEOs well when their companies prosper, and their employees also share in the rewards. But there is something wrong when senior executives get rich while companies stutter and employees struggle.
As expected, the Republican critique of Hillary Clinton's plan was on the short-term increase in capital gains tax rates. One potential presidential rival, Senator Marco Rubio of Florida, called it an old-style Democratic tax increase straight out of the 20th century. For Nightly Business Report, I'm John Harwood in New York.
Clinton's speech came amid reports of a possible investigation into her handling of classified emails while she served as Secretary of State.
Biogen cuts the outlook for its blockbuster drug, sending shares way down, and that is where we begin tonight's market focus. The biotech giant lowering its forecast for full-year earnings and sales because it just does not expect its key multiple sclerosis drug to sell as well as hoped. And in the quarter just completed, total sales fell short of the consensus. Shares, as a result, tumbled 22% today to $300.03. That made Biogen the worst performer in the S&P 500. And positive news, on the other hand, for GlaxoSmithKline. The firm got approval from European regulators for the first malaria vaccine ever. The vaccine does still face hurdles before being rolled out for use in Africa. Shares off 1.5%. They finished at $41.39.
Tyler, Xerox saw its revenue and profit tumble in the second quarter as currency fluctuations and the firm's document technology business dragged down results. Its earnings outlook also coming in at the lower end of the expected range. Still, shares rose 1% to $10.94. And VF Corp easily beating Wall Street's estimates on both the top and bottom lines. The maker of North Face, Wrangler, and other apparel brands also hiked its full-year outlook. Shares were off a fraction, though, on this down day to close at $74.50.
And now to our market monitor, who finds opportunity in some blue chip stocks he says should be in your portfolio for the long term. Couple of financials he's going to talk about. Last time he was with us was December 2014. He recommended ExxonMobil. It is down 10%, Chevron down 13%, and Schlumberger basically where it was. Hank Smith, welcome back, Chief Investment Officer at Haverford Investments. Let's talk first, for the record, I don't mean to bring up painful memories, but two of those three I didn't do so well. It has just not been a good time for energy.
No, it hasn't, but I like how you emphasized for long-term investors, and at least you're getting paid a very healthy dividend and a growing dividend, both with Exxon over 3% and Chevron now over 4.5%.
So you're still happy owning those companies?
That is correct. We still own them in our portfolios, and we're buying them for new clients as well.
Happy might not be the exact word that you would use, but you're certainly satisfied owning them.
We are. Again, we have a long-term perspective, and over many decades, regardless of where the price of oil has been, names like Exxon and Chevron have delivered excellent total shareholder returns.
But right now you think investors should be looking at financials as well, and what are some of the names that you like?
Well, we like the two highest quality banks in the United States, if not the world, Wells Fargo and JP Morgan. They're poised to do well in a rising interest rate environment that will help their net interest margins. Also, particularly with JP Morgan, it looks like the headwind of legal and massive fees is starting to dissipate and will be much less so on a go-forward basis. The companies are returning money to shareholders in the form of dividend increases, so you have a 2.5% dividend yield with both of those companies, and you can expect annual increases each year, and they're valued quite reasonably at these levels.
Yeah, you certainly have chosen sort of best of breed in that area. UTX, United Technologies, a company that's been in the news this week. They're selling off their Sikorsky helicopters. They had a little bit of an earnings stumble, if I'm recalling correctly, but you see this decline in the stock as a buying opportunity.
Yeah, it's almost a bear market type decline of about 20%. They're in great businesses, Otis Elevators, Pratt & Whitney jet engines, the Carrier building facilities that have wonderful reoccurring revenues. There's some temporary headwinds, the stronger dollar, concern over China slowing, but we think this is a good buying opportunity. And to take a Warren Buffett-like viewpoint, with the proceeds from Sikorsky, they're going to be able to buy much more shares than previously at these lower prices, so we think that will be good.
All right, Hank, thanks very much. I appreciate your long-term perspective. Hank Smith with Haverford Investments.
And coming up, how Cuban interns are learning how to be entrepreneurs the American way.
Major case today, Chicago judge ruling that a 2014 law aimed at reducing that city's multi-billion-dollar pension shortfalls in two of its major pension funds is unconstitutional. The overhaul, which was previously approved by lawmakers, sought to eliminate nearly $10 billion in unfunded pension liability by cutting benefits and increasing contributions. Would have affected more than 60,000 city employees and retirees. Chicago has the worst funded pension system of any major U.S. city.
Tyler, a wide-ranging tariff deal announced today by the World Trade Organization. Dozens of countries have agreed to get rid of duties on more than 200 information technology products, from video game consoles to GPS devices. This is the first tariff-cutting deal announced by the WTO in almost 20 years. The U.S. Trade Representative says the agreement will support 60,000 American jobs.
And speaking of job creation, when Americans want to start a small business, the resources at hand are virtually endless. But in Cuba, it is a whole different story. Kate Rogers tells us about a new program that's giving young Cubans a chance to become entrepreneurs.
Have you ever had so much Wi-Fi bandwidth in your life?
For these Cuban students, the answer is no. But as the U.S. has resumed diplomatic relations with Cuba, a program called Innovadores is bringing 4 Cuban interns to New York City for several weeks this summer to learn about entrepreneurship the American way. Miles Spencer, tech entrepreneur and angel, is funding the program through his nonprofit CAA. The students are shadowing science, technology, engineering, and math startups at Manhattan's Grand Central Tech Accelerator.
Our vision for the program is to have these 4 kids learn about innovation here and return to Cuba to solve problems in Cuba for Cuban people, but also to serve as the core for an incubator in Havana, where other like-minded innovators that are already in touch with these 4 can gather get access, get mentoring, and learn to solve those same problems.
The program came to be thanks in part to the help of
Right.
John Caulfield, former chief of the U.S. intersection in Havana, who got the State Department and Cuban government on board. While young Americans have the ability to launch startups with little more than a Wi-Fi connection, would-be Cuban entrepreneurs face significant hurdles in launching new ventures in the communist nation, among them broadband connections and mentorship opportunities. Sage is one startup at Grand Central Tech providing the mentorship. The company takes food data and personalizes it for consumers.
I personally lived abroad and did internships myself when I was younger. So I lived in Bolivia for a year, which is a very impactful experience for me. And so I'm very happy to be able to give somebody else a similar experience.
For some interns like Raul Pereira, who's studying telecommunications in Havana, the technology alone at GCT is something to marvel at.
You have all the right equipment here. We are equipment less in Havana. So I would love to see all and learn and try to make it pass it to people in Havana and Cuba in general.
Others, like Gabriela Rodriguez, hope the experience will prepare her to one day run a business of her own.
We can maybe all get the chance to start a new company, and if it happens to me, I'll be ready.
For Nightly Business Report, I'm Kate Rogers.
That's Nightly Business Report for tonight. I'm Sharon Epperson. Thanks so much for watching.
And I'm Tyler Matheson. Thanks from me as well. Have a great weekend, everybody. Enjoy it. We'll see you Monday.